Today we're doing a slightly different type of video, but we feel it's a better way to share the most important trading psychology tips that can improve your mental approach to trading. Let's start with one of the most important trading psychology tips, learning to manage risk. Now, risk and reward are what it's all about. And to be honest, most traders do mishandle this part. Instead of preparing in advance and learning how trading works, many just go all in before they understand, for example, how the markets work, or they end up losing money they can barely afford to lose in the first place. The first key to risk management is to always trade with money that you can afford to lose. How much money you have to start off with doesn't matter when this part of risk management is involved. No matter what your income is, whether it's high or low, your trading account should never have money in it that, if lost, means you are going to be severely financially damaged. It doesn't matter how good an opportunity you think has appeared before you, because I'm sure we do all feel that way, but you should always consider, well, what happens if you end up being wrong? How much could you actually end up losing? If you do this, even in the worst case scenario where that does happen, you should be in a position where it won't affect your lifestyle or the opportunity to invest and trade again. That's a very good rule of thumb. We'll be doing a separate video about risk management where we'll talk in detail about other related topics like the risk-reward ratio, the percentage you should risk on every trade, and how to adapt to losing as well as winning trades. The next psychology tip is another important one, and it will help with your discipline before, during, and after trading. To help with your focus when it comes to trading, you need to have a trading plan outlined, and preferably this is written down. It should detail what instrument you're trading, the conditions and levels at which you're prepared to open a new trade, and when you're in that new trade, when you adjust the position if necessary, or finally close the trade out. Having a take profit and stop loss level are also important parts of this plan. Sticking to the plan will help keep your mind from wandering and overthinking and agonizing about each step. Overthinking during a heightened period of stress usually leads to mistakes as the emotional and more primal parts of our brain take over from the reason and logic focused area. And let's not forget, risking money is definitely a stressful activity, as I'm sure most of us already know. Keeping yourself grounded and coming up with a sort of a playbook for different situations in the markets can help prevent mistakes and limit the damage these mistakes can end up doing. Our third tip is to try and overcome your inner greed. You don't need to be a greedy person to experience some levels of that emotion while trading. When it comes to financial markets, it's more or less a natural occurrence, but it's something that should be kept in check for as much as we possibly can. You might have come into trading looking to get rich quickly, or you may have just had a winning streak in the markets when it comes to your trade and think that finally you've got the secret of the markets figured out. But in trading, everything can change really quickly. A trend that had been going for some time can switch direction. A company that had been doing well can have a bad quarter. And of course, we can see a currency can get devalued overnight. So having a plan prepares you mentally for almost every scenario and in turn keeps those stress levels low. The less stress you experience, the better your decision making should be. Our fourth tip is for something very specific, something that some traders are prone to doing after losing, the so-called revenge trade. This happens when you have a losing trade, then you fill up with negative emotions and possibly even anger. So you quickly decide to get your money back, regardless of what the market's doing or your own mental state. Quite often, the revenge trade happens with the same asset you lost money on. You feel it owes you some money. So just like other mental states, it can occur naturally. No one likes to experience defeat, and we want to get back at whatever beat us. But in this case, the thing that beat us is the market. It's a neutral juggernaut influenced by hundreds, thousands, even hundreds of thousands of variables. And it doesn't really care that you lost money. The market is not an enemy, and it's wrong to treat it as one. We shouldn't look at it that way. To avoid revenge trading, it's always wise that we check ourselves after closing a trade that ended up losing money. It will be unpleasant. It might even be painful for some, but you should let the negative emotions run their course. Let them sink in and dissipate and not affect your trading attitude. Instead of quickly trying to erase these negative emotions, you should stop trading, take a break, get away from the screen, and when you get back to the charts, just try to analyze what went wrong, if anything. Not every trade can be a winner, but learn from the loss, take some value from it instead of repeating it and possibly making the same mistake again. The so-called fear of missing out, more commonly referred to as FOMO, this is the next thing you should take a hard look at when thinking about psychology and trading. This FOMO can be one of the main causes of losses because it makes many traders open trades in volatile assets that probably aren't suitable for smaller and medium-sized accounts. Usually, the move up or down has already run its course, they're sucked in by that, and the majority end up joining after the party is over. So, how can we deal with this? Well, first of all, it's advisable not to rush in without examining in great detail the reasons an asset is moving. Are its fundamentals that good that in your opinion you think it will continue growing? Is it speculation and the crowd pouring into it and driving prices up? You can still trade it, but just try and understand why this market is moving. Other more specific points that we can think about when having the urge to join the crowd on a FOMO trade is take a look at the market very, very carefully, the volatility. Are we seeing moves in both directions? Could we have a better entry point? Is the momentum increasing? Is the crowd psychology still driving the market in the same direction? Or actually, is it weakening? Should you open a smaller than usual trade, but with a wider stop loss level to take notice of that increased volatility? Double check and adjust everything. And if you're happy with how things stand, only then should you open a trade and you're countering that emotional pull of the FOMO effect. Our sixth tip is to regularly review your own performance so that you can see the full picture. This has two components, an external component and an internal component. The first part is easy. Just keep track of the trades you make, the circumstances and conditions in which they were opened and then closed. And just like we mentioned before, if you made a mistake, you can learn from them. But the second one is a little bit harder. It requires dedicating some time and space to reflect on your emotions, your decision making, and of course, everything else out there that could be impacting your trading. Different approaches work for different people. But in my experience, finding some time to think and review after trading is done and you're away from the screens allows you to process the ups and downs of what's been going on in the markets and with your own trading. Our final trading psychology tip is to take breaks. Trading can be mentally exhausting as it eats up your time, eats up your attention, and often your mental capacity. It is a challenging activity that requires people to have a solid level of mental fitness and alertness if they're going to succeed. If you day trade in particular, in and out of the market several times during the day, this should be part of your trading routine. If you trade a bit less frequently, you can occasionally sit out different situations and just observe how they unfold without risking anything on their outcome. This will allow you to recharge and improve your chances to make the right call when the next opportunity comes along.